S. Sridhar, Director Finance at Pfizer, joins in to chat about the earnings. Sridhar, hi, afternoon. Firstly, your numbers are not comparable to last year due to an accounting change. Post adjustments, what's the kind of growth that your company has seen on both the top line as well as the bottom line?
Well, for the top line, our growth is, we report 11%. We had a callback of some insulin voluntary recall. And net of that, for the quarter, will be 14%. And YTD is still strong, 13% growth. The bottom line is concerned, though it's not comparable, on a like-to-like basis, if I were to knock off the insulin expenses we had, our quarter would be around 20-odd% growth. And YTD would be still 12% growth.
It's been a flattish growth that you've posted in this quarter. What's the reason for that?
Such as the period is not comparable, and we had a one-off expense of insulin. We had a voluntary recall of insulin, and for the quarter, a 10 crores impact on a voluntary recall. And net of that, like I said, for the quarter will be 23% growth. And on a YTD basis, if I take 12 months identical period, we'll still grow at 12%.
Sridhar, what about the new launches this quarter? What kind of new launches are you looking at for the entire year? Because we believe that the company had indicated that it is going to focus on 4 to 5 new launches per quarter to sustain growth in the formulations business.
Yeah, so we launched about 7 products this quarter. On a full year basis, 26 products we launched. And these constitute about 5% of our turnover, which is doing pretty well. We're having a mixed response. Some of our products are doing really very well, and some of them are slightly below our expectations. But overall, at a 5% of sales, a pretty good launch.
Sridhar, you've aggressively increased your field force in the past in order to expand your reach to Tier 2 as well as Tier 3 cities. What kind of additions can we expect for the balance of the year? And do you think field force expansion and new product launches would sort of scale up your growth rates to 17 to 19% over the next 2 years?
Well, our ambition is to really grow faster than the market. That's a stated ambition there. And the additions of our field force the last year or so actually enabled us to launch close to about 30 to 40 branded generics. And has helped us to really enhance our coverage from Tier 1 to Tier 2. And we had a challenge in anti-infective market, and therefore you see one of our products doing little below the market growth. Ideally, we should be going higher than the market, which is currently around 16% now. Our ambition is to go a little higher than that.
After the global acquisition of Wyeth by Pfizer US, most of the analysts are expecting, Sridhar, that Indian subsidiaries are going to be merged in the same spirit as well. Till when can we expect the swap ratio for this merger to arrive by? And when would this merger be completed?
I'm not able to comment on this now, this juncture. Currently, as of now, we don't have any information. So we'll have to wait and watch for this.
But would it be this financial year, if you could give us a ballpark timeline?
I can't comment on this because this is that no decision has been taken at this juncture. So I'm not able to really comment on the timelines for the time being.
Fair point. How has your anti-infectives, respiratory as well as gastro segments performed, and what is the likely growth path for these segments going forward?
Anti-infective, we had a struggle. There's a slowdown in the industry itself. So one of our major products had a slowdown for the quarter. Respiratory has done, for the full year basis, a strong 15% growth. That's done reasonably well. The vitamin segment also has done a 15% growth for the full year. So both these segments done well. The antacid market, which is flagship Gelusil brand, has grown faster than the market for the quarter and for the full year. So we've done reasonably well versus market for all these products.
The street also believes, Sridhar, that Pfizer's return ratios have been subdued over the past year, mainly due to inefficient capital deployment. Is this something that you would agree with?
I don't think so. I think we have a fairly consistent dividend-paying policy. We have maintained that over the last few years there. At this juncture, we always feel that cash on hand is always a good asset to have, especially in the current economic scenario. It helps us to leverage on any kind of opportunities in terms of inorganic, in terms of brand acquisition, etc. So in order to, therefore, we have been fairly more or less the ballpark on payout ratios. So I think it's a fairly consistent performance in that respect.
Any delisting plans?
No, I can't comment on that, no.
So you're not denying it outrightly, are you?
No. There's no such plans at all as of now. We continue to be committed to the market, and we are in the market.